starting with the third sections now, questions about the investment process. So the next question is, what's the greatest challenge of managing a portfolio with a fairly low number of stocks? That's from Nathan in London.
Going back to my previous career, I think the greatest challenge about running a high conviction portfolio is about the resource that you have. And at Newell, there are 5 of us in the investment team, so we don't feel that is a challenge. But the way that you can think about that as an investor is we are very focused investing into 25 to 35 companies. And typically, I think when you are running a global fund or some other funds, if you're not managing a lot of money, typically you don't get a lot of people in the team. So let's say if you only have 2 people in the team covering about 70 stocks, versus, let's say, 5 of us covering 25 stocks in the fund, you do the maths to work out if each of one of us work 10 hours a day, multiplied by 5, divided by 25, versus another team, which you only have 2 individuals covering 70 stocks, less focus. And the output would tell you that we would be spending about 7 to 8 times more per company per month versus some of our competitors. And so I think that is the greatest challenge. And how did we come to that decision in the first place to have so many people in the team is a decision that Peter Hargreaves and myself made at the start when we were managing for a small sum of money. And that's an investment that we made as a company. And I think that's very important. So once you have the level of resource to do the work, then I think the next 2 things is actually it works hand in hand. That when you're running a highly concentrated portfolio, that you become more disciplined, that if you have you have a new ideas that's sitting on the sideline that you really like, you really need to ask the question, is it better than the 30 names that you have in the fund? Or even if you're sizing the position, you might want to say, oh, I want to invest more in this company, but then you would, because we have limited capital, then you will be taking away the capital from another company which would also be in the fund but may have a bigger holding. So I think once you have the resource to do all the work, it actually works quite beautifully that at all times that we want the fund to reflect the highest conviction ideas that we have outside within our investable universe.
Thank you, Stephen. Next question. So how does the team account for short-term market sentiment versus long-term fundamentals when assessing valuations of underlying stocks? That's from Tom, who's also in London.
Yep. So we do not define risk as volatility of share price. We define risk as permanent loss of capital in line with fundamentals of the company. So basically what happened is, I'm sure we have seen it recently in terms of the market movement, and we definitely have seen it many more times over the last 3.5 years that we have been around, that from time to time the market could be quite volatile in terms of rotation from value to growth, or the market become quite excited about reflation, etc., etc. But then that is share price volatility. We would be asking the question, is that reflected in any shape or form based on fundamentals? And if the answer is not, then we would take the opportunity based on the share price volatility to invest more into those companies at a cheaper valuation. And if I give you one example, is about Microsoft. About this time last year, that during the COVID sell-off in February and March, at one point Microsoft, the share was down about 25% from peak to trough, in line with the market, S&P 500 index. But then when we have done the work, you try to estimate what sort of earnings downgrade would we expect from Microsoft versus the S&P 500 index. And obviously the S&P 500 index would include the likes of a lot of highly levered companies, airlines, energy, oil and gas, etc., etc. The estimate that we got to would be about over 20% for the market in terms of earnings downgrade. The actual number would be about 30 with hindsight now. But at the time that when we have done the work on Microsoft, which is a big holding in the fund, the earnings downgrade would be less than 5 to 10%. The actual number is actually just a few percent downgrade in 2020. So basically, when you have the shares going down 25% with the earnings downgrade of less than 5 to 10% versus the market down similar, but with earnings downgrade about 20% plus, then you will be arguing that Microsoft was trading at a very significant valuation discrepancy to the market at the time. So we took the opportunity to invest more into Microsoft at a very attractive valuation. So basically, the answer to your question is we like volatility in the market, and we see that as an opportunity, as long as it doesn't affect the fundamentals of the company that we invest into, then we are not worried about volatility.
That's a good way to look at it. I note that PayPal has dropped out of the top 10. May you explain your valuation methodology and sell discipline? That's from Nazrov, who's in London.
Yep. So just to remind our investors that after we have done all the work on a company, and we already talked about that, there are 5 of us, we spend quite a lot of time researching on the company, we would translate our understanding into a financial model. So for every holding in the fund, we would have a unique financial model for those companies, taking into account the industry they are in, how we factor in geographic split, the margin expansion, etc., etc. And then we would try to forecast the earnings over the next few years for this company. So one way to gauge valuation is whether we have a differentiated angle in terms of our forecast versus the market expectations. And if I just give you one example, that you could have a company trading at, I think some people look at PE ratio. We never look at PE ratio. It's quite a low quality metric when you talk about valuation, but just to use it as a scenario. So you could have a company that's trading at 15 times, 1.5, versus a company trading at 25 times PE ratio 2 years from today. And people will say, oh, this company trading at 15 times is cheaper than 25 times. I think most people would agree with that. It's cheaper. But is that really cheaper? We would disagree that it's cheaper, because it would depend on the market consensus in terms of the forecast. So basically, if we forecast this company trading at 25 times, that our earnings forecast is 10 to 20% ahead of the underlying earnings, the PE ratio, the YE, then it means that the 25 times number that you're looking at is incorrect. It could actually be maybe 18 to 20 times, because we are much ahead of the market consensus. On the other hand, when you have a company trading at 15 times and then you think it's cheaper, but then if our research proves to be correct, that we could be forecasting this company is going to make 10 to 20% less money compared to what the market expecting. So if you put our numbers into that PE ratio, the earnings as a denominator, it could actually be trading over 20 times. So to us, that is the incorrect assumption, and obviously it's an easy way to gauge the valuation of company, but it's all about the fundamentals. It's all about the numbers that you put into that fundamentals. You can put any numbers and it will just give you the incorrect answer. So I think that is what we do. And the reason that PayPal have dropped out from the top 10 recently is valuation. And as I outlined earlier, that we have some new holdings. I think I'm sure we're going to that a bit later, that in order for us to build a position in a new holding, then something has to give. And looking at the performance of PayPal since last year, I mean, it was up over 100%. And on our valuation framework, we still feel that the valuation is reasonable, but then it's not as attractive as 12 months ago compared to some other holdings that we are putting your money into now.
That's really interesting. Thank you. Tech stocks have been at their strongest during the pandemic, but how important will they be within your portfolio going forward? That's from Robin in Maidstone.
Yep. So when we first started 3.5 years ago, we started with a blank piece of paper, and we didn't have any in terms of the kind of like a understanding that maybe we should have what we have now 3.5 years later, in terms of about 50% of the fund is in technology related names. All of this has been built up over time. And I think one thing that we have learned over the last 3.5 years is we definitely have liked a lot in terms of company that could facilitate digital transformations. And there are two big themes. I think now everyone understood it after the pandemic, is working from home, which is the likes of Microsoft, Adobe, Autodesk, etc. And then you also have the e-commerce, which is shopping online. That's the likes of Amazon and PayPal. But obviously, it wasn't very obvious at the time when we first started, because a lot of people would still be going to the high street, people would still be working in the office and would say, oh, I don't actually need this. So that is something that we have picked up since we started. And the more work that we have done in those areas, we discover that these companies are quite high quality businesses. And if I give you one example, which is Microsoft, is the company that I referred to earlier, is one of the highest quality business that we have in the fund, is net cash, very high margin, very scalable in terms of the business model. Everyone is basically adding the Office 365 if you're an office worker, etc., and then you're paying Microsoft a fee on a monthly basis. And there's not much cost to manufacture the product. It's the same product for everyone. In contrast, if you're producing a kit, then you would have a bit of manufacturing costs on an ongoing basis. So I think software companies such as Microsoft is actually very high quality, and that is not going to change. In contrast, I think if you're referring to, we do have a small investment in Unilever in the fund, which we deem as relatively lower quality business versus the life of Microsoft. And a lot of things have changed for Unilever. I think if you look at Unilever about maybe 10, 20 years ago, it would definitely be superb quality because they have pricing power. Everyone is going after the products in the developed market like us in the UK. But something have changed over the last 10 years that all the supermarkets have now come up with their own brands, and I think people trust those brands much more now. There's a lot of competitions in terms of disruptors coming into the market because they no longer need to rely on the supermarket to distribute their products. They can sell to us directly online, so they can build up a lot of traction. So Unilever, while it remains a good quality business, it still delivers about 20% return on invested capital, but it's significantly lower quality versus the likes of Microsoft. And I think the pandemic have definitely given Microsoft a massive leg up in terms of people signing up on Teams, people using more of their service, etc. So I think that is the high-level take on technology. But as I said at the beginning, there's a lot or many more technology names that are trading at extreme valuation or in a bubbly territory, and then their business model are quite low quality. I'm happy to expand on this if people are interested in the live Q&A part. It's the likes of like Netflix, Zoom, which we're using today. We dislike them a lot in terms of business model. We're paying them today, fine. And then like Uber, Deliveroo, which is about to list in London. Those quality of the business are quite low. So they are technology, but we're not interested. So I think we are highly selective on that front.
Well, let's hope Zoom doesn't let us down. That's us just past the halfway mark of the webinar. It's just gone past 1:30, and we have another question, which is how much consideration is ESG given in investment choices? That's from Paul in Newbury.
We consider ESG as a risk factor to determine whether a company can continue to deliver high level of return on invested capital. And the way that we go about this is when we look into when we research on our company, we'll be asking the question, are these companies causing harm to the environment, such as like a coal mining company, which we would never be interested? Are they selling products that are killing people in terms of, let's say, smoking products? Or do they have weak corporate governance, which is one of the ways that we define high quality businesses with a good management team? So I think if the answer to those questions are yes, which makes them very low quality businesses, or ESG unfriendly being to ESG, then we would not be interested. But on the other hand, I think typically when you invest into high quality businesses, you would find that they would be in a quite good shape in terms of the corporate governance, in terms of how they interact with consumers, how they are being quite caring to the environment, that they do the right things. And so I think that's the way that we look at it. But I think one thing just to caveat that this is not a ESG high impact fund, so we're not actively seeking for companies that might be doing good to some of this area, but we expect them to behave sensibly within the framework.
Yeah, I think it's expected of everybody now, really, isn't it? Thank you, Stephen. That's it for the investment process questions. We'll now tackle stock-specific questions.